Thanks, Michael. And the only thing I'll add to Michael's little introduction is that our 2022 FDD is going to be finalized this week and then introed on April 1st. So for some people in this room who are in what's considered a registration state, we'll have to switch you over to that one. And basically everybody who comes to the next Discovery Day will be moved over to the 2022 FDD, which we're really excited about because we had a really good year last year. So it made the numbers even more robust than the 2021 FDD. I do have a hard stop at 11:15 because our Cleveland franchisee, who's breaking ground on his building soon, is scheduled a call with me. So I can't run extra. So we'll try to keep the intro short. Just a little bit about myself. I come from a finance background. I worked at TD Bank in retail banking and then TD Ameritrade brokerage. I moved over to asset management with Merrill Lynch. And then lastly with T. Rowe Price, working with small business owners on retirement plans like SEP Simples, KIOs, individual 401ks, and non-safe harbor 401ks. And so I had several securities licenses. I was pretty invested in my career in finance at that point with a Series 63, 66, and 7. And I had no intention of leaving my job at T. Rowe. It's a really good company based out of Baltimore, which is where I live, right outside of Baltimore, near the Gettysburg line in Pennsylvania. And but I always had an entrepreneurial side to me. I always was, doing side hustles, if you will. And I thought to myself, maybe if I, start a business that will scratch that itch and I'll stop, having a wandering eye for other opportunities. And so I was looking at businesses that I considered to be non-skilled manager centric, meaning that if your key employee left, that you could still have continuity in the business. And my thoughts were that if I could get into a business where I could keep my really well-paying job and stay in this career that I had built up over several years, that, this is what would scratch that entrepreneurial itch. And one of the businesses that I looked at was the quick lube space, which I viewed as a quasi-utility in the sense that, every car on the road that's not a Tesla requires an oil change, and it's a reoccurring business. So the business is a steady business, and it's very reliable, and you can do good financial modeling based around your customer base. So there was a couple in Harrisburg that was on their way to retirement, and I was able to take over their shop, which had some dwindling sales problems. The owner was kind of checked out. And I thought to myself, what is the best way to, I wouldn't view it as disrupting the market at the time, because I think that's a little bit, that would be a little overzealous, but I definitely wanted to reverse engineer the negative reviews that the industry was getting at the time. So I spent a lot of time reading Yelp reviews and at my desk at T. Rowe Price, and just trying to figure out what were the pain points in this industry, because I feel that most great businesses are built out of a consumer need. And so we were very forward thinking with social media marketing at the time. In 2014, it was called Facebook Dark Post. They were extremely cheap because none of the big brands were really doing anything with it. And that's basically the best time to get into these types of programs. And we had a lot of success. We opened a second store in Dillsburg, Pennsylvania, which is a town of 6,000 people. We saw success there. And then we opened a third store in a suburb of Chicago, which really validated the model, because at that point, we were putting all these processes into place, because I had intended to stay at my job, which I did eventually leave because I was just having too much fun running the business. But very early on in the business, it's woven into the DNA of the business to be absentee run. And so the Mount Prospect store in Illinois really validated that model, because I physically couldn't be there on a regular basis. And to this day, that's one of the higher performing stores. So the model for me was validated. Our fourth store was in Pittsburgh. Our fifth store was in Youngstown, and Youngstown is 40 minutes outside of Pittsburgh. And the Youngstown store was the first store that was completely vacant, and it was a from a UI UX standpoint a complete build out. We got to design where the tanks went. We got to design how where everything would be, from the posters to where the customer checkout area would be. And so that was our first, what I would call, scratch build store, where there was 0 customers on day one and the store was built from scratch. So when we got to 10 stores, I started thinking about, how do we make this more operator friendly? I've always felt that this space has kind of created a vacuum that has caused only ultra high net worth individuals and private equity to funnel into this space, which has led to a disparity in the service that should be provided. The reason for that is, to a lot of people, the quick lube space is a portfolio game, where if you open 10 stores and you have 2 stores outperform the rest of the portfolio, it can pay for the entire thing. And so you'll see these massive groups of Valvolines or Jiffy Lubes that are owned by large family offices or private equity groups. And I think that really affects the level of service that is given to the customers when that model is created. So the first problem for us to solve was the building itself. If anyone's familiar with commercial real estate, there's a couple websites like LoopNet or CREXI.com. If you type in oil change or quick lube, you'll see that these buildings sell for $2, $3, $4 million at a 6 cap. That puts a lot of downward pressure on the operators of those stores to, make enough revenue to cover the net operating income of the facilities. Long story short, we feel as though we've solved the building problem. Our buildings are a fraction of that cost. So when situations like the pandemic or the lumber crisis that we had, we've had so many crises in the past 2 years. Sometimes it's easy to forget about the sub crises like the lumber one. And then now, obviously, the war happening in Ukraine, that impacts the cost of metals significantly. And so our building, and all buildings get impacted, but 20% impact on a $300,000 building is a lot more palatable than 20% impact on a $1.2 million building. So we feel that we're positioned really well right now. I teamed up with Fran Devco because there's a lot of people in that group that have experience bringing an emerging brand to scale, and that was important to me. And Michael, Chris, Chuck, Sung, Kristen, everybody on the team, they took the time to understand the story, and they're really good stewards of our brand. So it's not a surprise to me that we've had this kind of success with the people on our team telling our story. So I don't want to go I could talk about it at length. It's been a crazy 8 years getting to where we were, and there's so many stories to tell, but Q&A is typically the best way to get specific questions answered. I do ask that we keep it as macro as possible, because we do have a discovery day where we go into the quote unquote secret sauce of the business. So I don't, if we could just keep it to high level questions, we can go into really specific details either via email, or, everyone on this call is welcome to come to Discovery Day and see the behind the scenes of the business. So I'll let Michael curate the questions.
Oh, thanks, Costa. I'm just going to move from the left to right on my screen. And if we could just limit it to one question per candidate, at least at this point, and hopefully we'll get through everyone, and then we can move through round robin again. Gene, I see your name coming up first. Do you have a question for Costa? Good morning.
No, I don't have anything specific this morning. I'm just learning everything right now, and so I'm good. I just wanted to listen in and see what more I could learn today.
Okay, thank you. Thank you for joining us. Steve, you're up next. Do you have a question?
Yeah. Can you tell me the times that we need to fly in and fly out for the Discovery Day?
Yes, I can. I'll share that with you. So we generally will have a shuttle that leaves by 4 o'clock, and that's Baltimore, Washington International. So if you can try and get a flight that arrives at that time, if you do happen to arrive quite a bit earlier, then we will arrange separate transport for you. And then that is for Wednesday, the 20th of April. And then you could book a flight out of BWI anytime after 5 p.m. Eastern on the 21st.
Okay, thank you.
Okay.
And then for Costa, do you assist us with finding the real estate?
The real estate is the responsibility of the franchisee. That's pretty standard in franchising just for liability reasons. I think McDonald's is probably the most notable exception to this rule, but they're also McDonald's. We provide as much assistance as possible. So we have weekly calls with our back office team, as well as we have been able to partner with one of the preeminent real estate firms in franchising. We signed up with a company, Morrow Hill. If anyone wants to do due diligence on that company, they've worked with all of the major franchise brands that you can think of. It took a while for us to get on their radar. We had a lot of success in 2021, and so we recently moved over to them, and we're very fortunate that they were willing to take us on as a brand, because they're typically more inclined to take on established brands like Orange Theory, Sweet Frog, things like that. So we provide as much assistance as possible. Morrow Hill knows exactly what we're looking for, and the real estate market has been difficult the past 2 years because there have been a lot of brokers who have been gatekeepers. And when you're looking for a ground lease that's between $1,500 and $2,000, there's not a lot of juice in those deals for the brokers. So oftentimes when they're able to sell these other real estate deals because of the market, they're not even giving us the time of day. Things have seemed to cool down a little bit. And also Morrow Hill has a lot of established relationships with the decision makers, the developers, the landowners, so we can bypass the brokers completely from time to time. And that makes it a lot easier. But Morrow Hill has a robust CRM system that allows you to check in on your progress, see what the status of, waiting to hear back from the landlords, what sites have LOI submitted, things of that nature. So, we give as much tools and assistance as possible without actually making the choice for you.
Okay. Well, you'll give us a little bit of guidance on what to look for.
Yeah, Morrow Hill will definitely spearhead that, and then on the weekly call, we'll add our 2 cents. It's pretty straightforward for us right now. Our 3 core areas that we're looking at are ground leases on unused parking space. Parking spaces are severely overdeveloped in our country because of the suburban sprawl of the 1990s. Boscov's and J.C. Penney's and those types of places, they don't need 600 parking spaces anymore. Most of the walk-in malls are being converted to strip malls at this point, so there's a lot of opportunity there. We're also looking at neighborhood gas stations. The model for gas stations has changed drastically. If you're in a market that has like a racetrack or a QT or a Wawa, Sheetz, etc., the days of the 600 square foot convenience store are kind of gone, and now it's all made to order, event driven, massive gas station, 6,000 square foot gas station, almost restaurants from time to time. And so we're looking at those. And then also surplus real estate when it comes to small regional banks. We want to get into 0.17 to 0.30 acre lots because there's not a lot of competition for those types of lots. There's been a very distinct movement from all the big chains to create a kiosk version of their business. Chipotle launched one a month ago. Dunkin' Donuts has had a drive-through only version of their business for a while now. Church's Chicken in the Texas area, they have a kiosk version now. And so while I'd like to think that I invented the kiosk version of the quick lube space, it does seem to be a more prominent thing these days for established chains to create a more express version of their larger footprint.
Thank you. That's very helpful.
Great. Thanks, Costa. Brian, welcome. Thanks for joining us. Do you have a question for Costa? Brian Yannotta?
Yes. What is the current from start to finish, for the time frame from you get on board and you get your store open? What is the average on that?
There's a lot of variables there because a conversion will take a lot less time than a new construction. And then there's so many variables in new construction, it would be a disservice to give you a number and then it not actually come true, because we're seeing not only new construction permits being delayed, but certificate of occupancy is being delayed. The real estate portion is very heavily on the individual. We have a 10-unit franchisee in the Charlotte area that also has a development area in Atlanta, and they have 7 of their 10 leases already, and they've only been in the system for 6 or 7 months. And then we have some people that they're kind of getting a little analysis paralysis because they're only doing 1 unit and they want the spot to be exactly perfect, and they've taken a little bit longer. And then we have a couple of people in the system who have done conversions of existing quick lube facilities, which there's just not a large inventory of. And that takes a lot less time, obviously, because it's just a re-imaging of the facility versus having to go through the process of building the building. That being said, our buildings are manufactured in Holland, Michigan. They're put on a truck and delivered to the site. And the construction, once the permit is in hand, is a very short few weeks. So that is an advantage that we have by creating these prefabricated buildings. So the bigger variables are the real estate search, the permitting process. Once the permit's in hand, then things go really quickly because we'll be putting in the order for the equipment. The building gets delivered on a truck. It gets assembled on site. We contract the electrical and the plumbing at the same time. And then it's just a matter of getting the C of O. And then obviously once you have the C of O, you know, we have our scheduled trained, we have our schedule on a monthly basis. And we have it scheduled out for the next year. And we'll get you trained and have the grand opening checklist. And we'll establish a plan for that grand opening. And then hopefully we have a really good grand opening and off you go.
Great. Thanks, Costa. Joe Weaver, you're up next. Do you have a question?
Yeah, I do. I'm not sure if this is too in the weeds or not, but this has been what's been on my mind lately, which is sort of how to analyze your market area in terms of existing, competition, how many cars per day you think you can get, what the average ticket price is going to be, things like that are really big, revenue drivers.
Yeah, so I mean, I'm in a very diverse footprint with being in Harrisburg, which is more urban, and then Dillsburg, which is extremely rural, and then Mount Prospect, which is a suburb of Chicago. So I have a very wide-ranging footprint, and I don't have any discernible pattern because it often feels like in the lower to middle income brackets, those people are driving more. They're in jobs that require them to drive more. And for some of them, they even have more vehicles. We do utilize a service called GeoStrategies that has the MVA, the DMV registration, so we can see how many vehicles are in an area. The industry studies show that 85% of your customer base will come from within a 3-mile radius. So the more densely populated that 3-mile radius is, the more likely you are to have a higher car count. That being said, the Dillsburg store, again, is a town of 6,000 people, and that store does 20 to 25 cars a day at an average ticket of $70. Chris and Michael can share the industry study that has the nationwide statistics for the quick lube industry. We have a nice PDF that breaks it down, average manager salary, what oils are being used, because that will also influence average ticket. If you happen to have a large Toyota dealership in your market, then you're more likely to be selling a lot of 020, which is a higher ticket item. Whereas if you're in, an area that just sells mainly used cars, then you might be a lower ticket average because it might be synthetic blend 520, 530. But as far as like actual metrics that we look for, our barometer is 50,000 people, 3-mile radius. And your question about the competition, typically, I don't think that having one of the other quick lube chains in the area is a bad thing. That to me just means that the consumer base is educated on the service, and there's not this process of ramping them in and showing them that it basically becomes about showing them there's a better mousetrap. Automotive itself is very saturated. There's a lot of all of the above chains, and most of them use oil changes as a loss leader. And because they use oil change as a loss leader, people get upsold a lot of things, and it's not fun to take your car into Monroe or Meineke knowing you're about to go into battle. And so that's really where our advantage lies. And now that oil is up over $100 a barrel again, I mean, it was touching 120 in the middle of the night. I think it's probably 114 right now. They're not going to be able to sustain using oil changes as a loss leader for too long because they don't buy oil in the volume that we do. They typically buy them in 55-gallon drums. The logistics of transporting motor oil makes it so it doesn't really matter how large your chain is. There's no economy of scale, because if you're a Meineke in California or a Meineke in Maine, you're not buying that 55-gallon drum from the same distributor. So you kind of lose that leverage of being a large chain. So when you buy oil in bulk and it gets put in bulk tanks, you eliminate the marketing expense, you eliminate the steel cost, you eliminate the fuel cost of the box truck. There's a different type of truck, obviously a tank truck, but you're getting the most margin possible when you're purchasing oil in bulk. So I don't view having a lot of Mr. Tires and Monroes and Meinekes as a bad thing, especially these days. It's actually, it's been helping us.
Great. Thank you. Josh, welcome from Washington area. Do you have a question for Costa?
Hey, thanks, Michael. Yeah, I'll throw one quick one out there just from a sort of long-term vision perspective. Looking out the 10 to 15-year time frame, do you have an idea of specifically where you want to be at that point, or somewhat connected to it? I was going to ask you if you had any thoughts on are there regions that you're steering away from for one reason or another, whether it's environmental law or something related to the employment law?
Yeah, so we're already registered in California, which makes us one of only a couple of quick lubes that are registered in California, and we are registering in Washington in 2022. I think specifically, we talk a lot about top of mind brand awareness at Discovery Day. We do an exercise, and I don't want to give it away, especially if you guys are going to come to Discovery Day, but we go around the room and I ask everybody, when you think of fast food, what do you think of? And it's been a very interesting project or exercise, because in the very beginning, when we started this a year ago now, our first Discovery Day was March 28th in Cleveland. And I would say it was 90% McDonald's and then maybe a couple of others. And more recently, it's been almost 50-50 McDonald's and Chick-fil-A. And that shows that with the right service, you can change the narrative, you can change top of mind brand awareness. And so we are very strategically trying to push to get to 300 to 500 units in the next 5 to 10 years, so that we have that national presence. We can establish a national brand fund, because we don't have a national brand fund right now. I personally don't feel that it's right to pull another 2% out of your revenue for something that is very regional at the moment. But we will eventually establish a national brand fund. And then the goal is to have top of mind brand awareness so that when electric vehicles penetrate the market in a more meaningful way, I believe truly that our model specifically will be the surviving model, because there's still going to be internal combustion engine vehicles on the road. And it's very easy for people in my space to get into the narrative fallacy where they tell themselves a story enough in their head that they start to believe their own bullshit. Technology solves everything in this country. We are, the best of the best, the brightest of the brightest. Everyone wants to say, oh, batteries are not efficient. That's eventually going to get solved, no doubt. However, there's always going to be a market for the internal combustion engine, because at the moment and for the foreseeable future, it is more efficient. And just from a pure number standpoint, there's 350 million registered internal combustion engines on the road right now. Even if that number gets cut in half, which is very unlikely because electric vehicles represent about 2 to 4% of vehicles on the road right now, that's still 170 million internal combustion engines. There are a lot of businesses that have a smaller consumer base than 170 million of their consumer. So this is not something that's going to go away. Now, I think that some of our competitors that are taking the all of the above approach are going to get into a kind of brand crisis and an identity crisis, similar to what the American restaurant industry is kind of going through with what makes you pick Applebee's over TGI Fridays, what makes you pick TGI Fridays over Chili's, what makes you pick Chili's over Ruby Tuesdays. When you have no brand equity and no differentiator, then you get to a race to the bottom on pricing. And the only one that wins that race is Jeff Bezos. So I don't want to get to that space. I want to be known for something very specific. I think that the quick lubes that start doing brakes and tires and inspections and all of these things, they're going to lose the reason that the industry was created in the first place, which is to sell people their time back. And if anything, the pandemic has shown that people will pay a premium to get time back. I didn't think that fast food drive-through could get any more efficient. You used to walk up to the counter and say, give me the double quarter pounder meal with fries. Then it turned into drive up and say, give me the double quarter pounder meal and fries. And then it turned into drive up and say, give me the number 2. And then over the pandemic, it's drive up. I've already placed my order on the mobile phone. They throw the order through your window and you drive off without having to even say a word to anybody. So all of the startups that are happening these days are revolving around reducing the amount of friction between the consumer and the service. And so I think our industry was always ahead of its time in the sense that that's exactly how the quick lube industry was built in the first place. And so if we become the best at fast oil changes and people don't feel like they're about to go to war when they come into our shops and they know that they're just going to get an oil change, and we've eliminated the obstacles like the high labor, the immense amount of SKUs, the building expense, if we keep our overhead low enough that we can do oil changes only and still make a profit, then I believe that if we scale, if we execute, we can be the surviving model once electric vehicles do penetrate in a more meaningful way.
Yep. Thanks, Costa. And just to tie into what you mentioned, selling people their time back and not being a low-cost provider, you are still extremely competitive as far as pricing is concerned. I've had a number of individuals ask me that over the last 2 weeks, and I think dollar for dollar, buck for buck, penny for penny, when you go in and you can get a great, friendly, transparent service, and you don't feel like you're being ripped off, but you can still get it at a competitive price. And the other thing is, with your efficiency, throughput, with the car count being one of your key performance indicators, frankly, you can do oil changes much more profitably than I think any other brand that's out there right now. So, Evan, I see you joined us. Thank you. Do you have a question for Costa?
Yeah, hey y'all, how you doing? I have a bunch of questions, but just for the sake of y'all's time, Michael, maybe we can follow up offline. But Costa, thank you very much. Just probably my most macro one. I mean, in your opinion, what separates your higher performing stores from the lower performing stores?
I would say continuity of staff. The manager is important. The manager is important, and I know I started off this call by saying I looked for businesses where the manager wasn't the most important, but that was more around the skills, not so much the personality. Some of my best employees have been overnight shift managers of quick service restaurants who have dealt with unruly customers and have learned how to deal with, have the actual social skills to look someone in the eye, know how to carry a conversation. I have stores where I have managers that have been with me for 6-7 years, and they have customers come in and, hey, how was Johnny's T-ball game? And, they've had that continuity, and that takes time. There is a ramp up period in our business that is impossible to get around. It's, I talk about Chick-fil-A, when Chick-fil-A has a grand opening, you can go there on the grand opening and then you can eat there 4 more times that week. When someone comes to our grand opening, that car is not coming back for another 3 months. And so you do have to wait till that interval starts overlapping before you start seeing the exponential effect of this business. But, the lower performing stores typically have had a combination of not a great location and trouble getting the right staff. And I think that's a lot of businesses. It's a really vague answer for you, but it's also the truth.
Well, Costa, Evan, that's an interesting question. I'll just give you one example. One of the managers that I know that runs a top performing location in Youngstown, because so many people come in, especially women, and they're guarded, their boyfriend or their husband has told them, look, when you go in, and they offer you all of these other services, say no, 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 no. And so they'll drive up, and what Daryl will do is he'll smile. He's very friendly, and he'll, they'll open the window and he'll say, oh, ma'am, welcome. Are you here for the Tupperware party? And of course, that's a humorous thing, and it gets them off guard and creates a very, friendly engagement right from the beginning. So anyway, just to expound on what Costa had mentioned about managers and the soft skills that we look for.
Yeah,
So,
and just to add a little bit more flavor on top of that, it's we deal with people often that are trained in a different way, and we have to untrain some of the things and get them on board with our vision. For a long time now, some of these guys have been beaten over the head by their district managers and their owners that the oil change only model isn't going to work and that the model is shifting. And so when we hire someone that has that prior experience, we have to untrain that out of them. And sometimes they just are not compatible. And it's difficult, especially when someone thinks that they know better than you. And so the stores that have really bought into our model and followed everything to a T are the stores that have had the most success. And then every time you have to take someone out of the system and replace them with someone new, it's almost like starting over. And that's really difficult. And that's no different from opening a pizzeria where, you have to retrain the pizza maker. There's a lot of parallels to other businesses, but I would say that is the biggest pain point for sure.
Thank you. Costa, it's 8:09. You have a hard stop at 8:15.
Yeah, I've got a call with Ben Capel.
Okay.
I texted him so I can push it a little bit if there's more questions.
Okay. Well, I guess we could start off. I apologize if I mixed up here, but does anyone else have any other questions?
This is Evan. I would throw one more out there. And just curious, if I may, and be as quick as you need to with your answer. But for someone who's doing multi-unit development, I understand the onus is upon them as far as the real estate, and that affects the timetable. But what is the expectation from headquarters as far as how quickly they need to do that? I mean, you're reading the FDD, and there's remedies that headquarters kind of reserves the rights to take if the development schedule doesn't go as quickly as possible. So what's HQ's expectations for someone developing multi-unit? And at what point do you jump in and say, hey, y'all aren't moving quick enough?
So, this is changing as we grow more, because I originally had one view on it. And then as the brand has gotten more notoriety and more traction, it's shifted a little bit. But obviously, as an emerging brand, we're not in a position where we're going to want to call someone out on a default and kick them out of the system, because the optics of that are terrible. It has to go on the FDD. It has to be reported. It's going to have to be, there's going to have to be a talk track around it. And just generally, it's not the type of person I am, because I understand that there's a lot of variables in business. When we first started this thing, we thought the pandemic was at its end, and it wasn't. We didn't know that there was going to be a lumber crisis. We didn't know that there was going to be a phosphorus crisis. And so I know there's variables that impact these things, and I'm not going to kick anyone out of the system unless they are being incredibly negligent in an important market. So there are certain markets in this country that are going to be important for us to capture. And if someone has a 5-unit muda, we're not going to want them to sit on it for 5 years. And so we will do our best to assist everybody, to help them out. We understand that the markets are tough right now. We've sold a lot of units in Houston. We've sold a lot of units in Dallas. Those are really hot real estate markets right now. And, we're not kicking anybody out of the system, but we also don't want anyone sitting on their hands either. And so it's going to be a pretty nuanced discussion based upon the actions of our conversation with the franchisee, our conversation with Morro Hill. Is the franchisees, checking up on the sites that Morro Hill puts in front of them? Are they adding notes into the system on why they don't like a space? Are they following up on, is there follow through, or are they just hoping that something falls into their lap? Those are two very different things. So it doesn't behoove us to kick anyone out of the system, but obviously we have to reserve the right to do that if it's an important market.
Thanks, Costa. Yeah. I don't know if you mentioned this earlier, but Costa mentioned the word muda, which is a multi-unit development agreement. If you move forward and you hear that term, that's what we call it in franchising, anything over 2 units. So I think we're running up against the clock here. Unless there are any other questions, Chris, myself, or Kristen we'll be following up with you, on next steps. And Costa, I don't know if you have any parting words, and thank you all for joining us this morning.
Nope, I'm all set. Thanks, everybody. These calls are always helpful for me as well. I appreciate the diversity of experience, culture, and questions. It only helps us get better each time. So thanks a lot.
Okay. Thank you. Thank you for your time. Hopefully all of us will see you in York, Pennsylvania pretty soon.
All right. See you, Michael.
Yeah. Thank you. Bye.
Bye-bye.
Thanks all.